Hello once again. We are looking at Chapter 4 Accrual Accounting Concepts today. So let's see what our learning objectives here are. So we are going to explain the accrual basis of accounting and the reasons for doing the adjusting entries. We'll prepare the adjusting entries for prepayments. We'll be looking at adjusting entries for accruals. We will prepare an adjusted trial balance and financial statements, and finally look at closing entries and post-closing trial balance. So recognition of revenue and expenses. So when it comes to the companies, they need to immediate feedback on how well they are doing. So from the accounting perspective, then the economic life of the business is divided into artificial periods, which is 1 month, 1 quarter, or a year. Okay, but when we look at these transactions, there are certain transactions that we come across which will affect more than one time period. And that is where your adjusting entries will come into play. So for your revenue recognition, so your revenue basically is the increase in your asset or it settles your liability. The revenue has to come from your ordinary operating activities of the business. So generally speaking then, for the merchandising businesses, they will recognize the revenue as soon as the product is sold or delivered. And for the service companies, once the service is performed, then we assume the revenue is earned. So you are good to go ahead and record that revenue. Under ASPE, the revenue is recognized when the performance obligation is substantially completed, when you can measure your revenue and the collectibility is certain. Okay, now the recognition of revenue may not be at the same time when cash is received. Okay, so you might have earned the revenue in this period, but the cash might not come until the next period. So under the IFRS rules, then the revenue is recognized when the companies satisfy their performance obligations. Now, with the performance obligation under the IFRS, this actually is quite a complex forte with the performance obligations and revenue recognition under IFRS. So we like you to know that this exists, but this is further explored in the intermediate accounting course. So under the IFRS rules, there is a 5-step process that we have to follow in order to recognize and report revenue. So the first step of that is identification of a contract. Is there an existing contract that exists with the customer? And that contract can be a verbal contract, it can be a written contract, formal, informal. It can take various forms. Once we establish the existence of a contract, then we will look at the performance obligations that are listed or included in the contract. So how many things does this company have to do before they can recognize revenue? Okay, is it just the sales of products? Or are they going to be doing any assembly, any installation? Because that also becomes another performance obligation. So the companies need to first determine whether there is a contract and then determine how many performance obligations are in that particular contract. The third step is to look at the transaction price for the whole contract. How much did the whole contract is being charged at? So that is your transaction price. Once the transaction price is determined in step 3, then step 4 is marrying step 2 and 3. So we take the total transaction price and allocate that money between your different performance obligation. So if the company had sale of a good and installation, that's 2 performance obligations, and we will prorate the transaction price between those 2 performance obligations. And step finally is when to recognize that revenue. So basically, when those performance obligations are satisfied at that point in time, the company does have the ability to recognize revenue from that contract. When it comes to expenses and recognition of that, the expenses are recognized or they are recorded when there is a decrease in the economic resources. So assets are consumed, that is they decrease, or the liabilities are incurred or the liabilities increase. So these also have to come from the company's ordinary operating activities. So just the same way as your revenue accounts. So they are tied to the changes in assets and liabilities, and they would often coincide with the revenue recognition. Okay, your expenses has to be matched with your revenue. Okay, so that is your matching principle. So your expenses that are incurred in the period has to be matched with the revenue that was generated in that period as well. Now, once again, the timing of the cash payment could be different. Okay, so you might see the utility expense being recorded in this period, but the payment might not happen till next period, which is okay. We are looking at when that revenue, when that expense was incurred, not so much as to when it was paid. So why do we not tie this to the cash? Is because we use something called as the accrual basis of accounting. So if the company is using cash basis, then the recognition of your revenue and expenses is tied to the inflow and outflow of cash. But under the accrual basis of accounting, we are not tied to the movement of cash. When we are recognizing revenue or income, we have to make sure that the revenue or income was earned. Whether or not you received the cash, if it was earned, then it becomes a revenue and we would record it. Likewise with your expenses, whether or not those expenses are paid, we would go ahead and book them as expenses if the expense was incurred or the item was consumed. With the cash basis of accounting, it's the exact opposite. The revenue is recognized when the cash comes in, expenses are recognized when the cash goes out. Okay, so that is where it is different. So cash basis is tied to cash movement, accrual basis is not tied to cash movement. Under accrual, revenue has to be earned and expenses have to be incurred or consumed. Because of those timing differences under the accrual basis of accounting that we are expected to follow, we will see those timing differences. So that's why we need to now adjust those accounts at the end of the accounting period. So the whole premise of adjusting entry is to make sure that your asset, liabilities, equity, revenue, and expenses, all of those accounts reflect the correct balance that they have. Okay, none of these accounts should be overstated or understated. And that's where we have to book the adjusting entries at the end of the period. Now, based on the trial balance, so required based on the trial balance may not contain complete and up-to-date data. So some items are just not recorded daily. Some costs are not recorded during the accounting period as they expire with the passage of time. And then there are some items that may be unrecorded because their amounts are not yet known. And this is where our adjusting entries will come into play. So there are different types of adjusting entries that we can do. So we have divided them amongst two major categories. One is the prepayment, the other one is accrual. Now, when it comes to prepayment, it can have two subsets. Either it can be a prepaid expense where the company is paying out cash in advance, but they haven't received the benefit yet. Okay, such as your insurance policy. So if the company is paying for a 12-month term in advance, then that's a prepaid expense. Your cash has gone out, but we haven't used the complete benefit out of that. On the other side, we have deferred revenue. Deferred revenue is when the company has received the cash, but they haven't provided the service or sold a product. This is like unearned revenue. The same idea, it's called deferred revenue here. So cash is received in advance, but we haven't earned it yet. So under the accrual, we can have accrued expenses as well as accrued revenues. Accrued expense is something where the service has been used up, but the cash has not been paid yet. So something like a utility bill. You know you have used the service, but we haven't paid cash for that. On the other end, we have accrued revenue, where the revenue has been earned, but we haven't billed it yet. That's why there is no cash. So looking at the prepaid expense to start with. So prepaid expense, as we said, is where the cash payment has been made. So we have purchased an insurance policy for 12-month period. So your journal entry, original entry at the time that the insurance policy was paid, would be a debit to prepaid insurance account, and you would credit the cash account. So that is a 12-month policy. Let's say you paid that on January the 1st. So on that point in time, your prepaid asset balance is correct. But with the passage of time, that prepaid asset has to reduce. It has to come down because we are using that insurance policy as we go. So at the end of the period, the company has to reduce the prepaid asset and take that money into the insurance expense account because it's now used up. So with the passage of time, we will have to adjust these asset, liabilities, equity, revenue, and expense accounts. So this is a very common example of a prepaid expense journal entries and what they look like. So let's say you have your supplies. So we debit supplies expense and we credit supplies. So that is an adjusting entry. Okay, where your supplies account is going up and your supplies asset is coming down. Now, when it comes to adjusting entries, there are some ground rules. One is that your adjusting entry is always done at the end of the period. Whatever that end of the period is, that is determined by the company, whether that is end of the month, end of the quarter, or end of the year. Whatever that period is, the adjusting entries will be done at the end of the period. Secondly, when the adjusting entries are done, there should always, for each journal entry that you book, there has to be one account from income statement, other account from balance sheet. Okay, income statement or statement of income, different names, but the same statement. Okay, so always when you do your adjusting entries, one account has to come from your income statement of income, and the other account has to come from your balance sheet. So your supplies expense account will go to your statement of income. Your supplies asset account will go onto your balance sheet. The other example is your insurance or your rent that is being debited and we are crediting some sort of a prepaid account. The expense account will go to statement of income. The prepaid account will go to balance sheet. Same thing with your depreciation expense journal entry. Okay, so you always need to have one account from statement of income, other account from balance sheet in whichever sequence they fall in. Lastly, the third rule of accounting or the adjusting entries is not to touch your cash account. So the other type of prepayment is your deferred revenue. So deferred revenue is also called as unearned revenue. So this is where the company has received the money, but they haven't provided the services or sold the product. So at the time that they received the money, they would have debited cash and credited deferred revenue or unearned revenue account. But when that revenue is earned, at that point in time, we would book an adjusting entry by debiting this deferred revenue or unearned revenue account and credit our revenue account. So basically, we are reducing our liability by debiting that and increasing our revenue by crediting. So debit to a liability, credit to a revenue, the rule of one account from the statement of income and the other account from balance sheet is satisfied. Accruals. So for your accruals, now accruals are something that has not been booked onto your statement, okay, up until you come to the end of the period. So at the end of the period, we look at our accrued expenses and accrued revenue. So any expenses where the item or the expense has been used up, but hasn't been paid for or recorded is then recorded here. So we would debit some sort of an expense account and we would credit a liability. So let's say debit utilities expense and credit accounts payable. Okay, one account from statement of income, the other account from balance sheet. Then on the other side, when we call something accrued revenue, then we are implying that the revenue has been earned. Okay, the revenue is earned, we have sold the product, we have offered the services, but we haven't invoiced this yet. So it's not there on the books. So at the end of the period, we would debit accounts receivable and credit some sort of a revenue account to account for our accrued revenue. Accrued revenue is always earned. So this basically is the basic relationship between different items. So for the prepaid expense, our entry is prepaid expenses debited and our cash or accounts payable is credited, and our adjusting entry is a debit to the expense account and credit to the prepaid expense account. So this is what we had talked about in the earlier slides as we were going through that. Okay, now one thing to observe here is when it comes to accrual, when you're looking at your accrued expenses and accrued revenues, these journal entries are not recorded onto the books up until you get to the adjusting stage. But with the prepayments, there is an original entry that is sitting onto the books which needs to be adjusted when you are booking your adjusting entries. So there's a fine difference there. Then comes your adjusted trial balance. So with the trial balance that we have created so far in the earlier chapters, we understand that the basic idea of a trial balance is to make sure that your total of debit equals total of credit. Okay, so trial balance, the idea of trial balance doesn't change here. Trial balance is still listing of all of your accounts with the ending balances, whether they are debits or credits. At the end of the period, your total of debit has to equal your total of credit. And this adjusted trial balance includes your adjusting entries. So once your adjusting journal entries are done, then we go back to our T accounts. We update the balances in those T accounts, recalculate the ending balance in those T accounts after adjustments, and then we bring forward that information onto your adjusted trial balance. Adjusted trial balance is the main source of information when it comes to preparation of financial statements. Now, when it comes to financial statements, we will prepare a statement of income that is always prepared first, and it will capture your revenues and expenses. Then we prepare your statement of changes in equity, because your income or loss from the first financial statement will flow into the statement of changes in equity, and the ending numbers from your statement of changes in equity then would flow onto your statement of financial position, which is prepared the last, and this will give you details on all of your assets, liabilities, and equity accounts. These are the examples that we will be working on in class with regards to the financial statements and adjusting entries. Okay, so the last step of the process here, and this is the last time that we will be doing the journal entries in this particular period. So this is the process of closing. So once your financial statements are ready, once we have prepared our journal entries, we make our adjusted trial balance, and from that adjusted trial balance, we make our financial statements. So once those financial statements are ready, then we have to bring the temporary accounts to a zero balance. Temporary accounts are your expense accounts, your revenue accounts, and your dividend account. So the way it works is, if we think of our financial statements, remember when we prepared our financial statements, we said our statement of income and statement of changes in equity, they were for the period ending, a year ending or a month ending or a quarter ending, something was ending, okay? So when those financials are depicting a certain time frame, then those accounts have to be brought to a zero balance so that we can start afresh in the next year. Why we do that is the companies want to keep their revenue, expenses, dividends separate for each year, okay, for decision making. Let's say if you're looking at the 2020 statement of income, you only want to know what is your income and revenues for this year. You don't want to muddy the water by taking a cumulative revenue, which is from the first day the company started up until today. Okay, same with the expenses, because that ways you cannot make any meaningful decisions, right? So the temporary accounts, that's why, are brought to a zero balance at the end of the period. That is after the financial statements are made. So those are your temporary accounts. Your permanent accounts is any account that sits onto your balance sheet. These permanent accounts, if you think of your balance sheet onto the title, the date is always reflected as of a date, which means that all the numbers on your balance sheet are as of a date. They are cumulative numbers, which is what that company looks like on that particular day. Okay, it's right from day one of operations up until the statement date. So all the accounts sitting onto your balance sheet are your permanent accounts. So we are only closing the temporary accounts. So the process of closing the temporary accounts is we first figure out which are our temporary accounts, which is your red accounts, your revenue accounts, all the expense accounts, and D for dividend. Figure out the normal balance in these accounts. Once you have figured out the normal balance, then we will do the exact opposite of that to make the journal entries and bring these accounts to a zero balance. So here is a quick summary of your temporary and permanent accounts. So your temporary accounts are all of your expense accounts, revenue accounts, and your dividend accounts. And our permanent accounts is anything that sits onto your balance sheet. Here we have listed the normal balances for your temporary accounts and your permanent accounts. Although permanent accounts, we don't really need that information right now. It's more of a refresher than anything, except of course for the retained earnings account. That account is not going to be wiped out, but it's going to be updated in the process of closing. So we'll see that, we'll see how that affects. So temporary accounts, your revenue accounts have a normal balance of credit. Your expense and dividend accounts are part of your debt equation. So the debit is for expense, expenses, assets, and dividends. Okay, so we have two of those items here, expenses and dividends. The normal balance in those accounts is a debit. Revenue has a normal balance of credit. So once you know the normal balance, then we will do exact opposite to close them. So this is what your closing process looks like. So first of all, we always close it in the sequence of the color red. So revenue accounts first, expense account second, and then we finally move on to dividend account. But in between, we'll have to clear out something else that we will talk about in a bit here. So your revenue account has a normal balance of credit. In order for you to close it, you're going to debit that account. The other half of your journal entry is then income summary account. Income summary is another temporary account that comes to life just for the process of closure. Okay, so when we are processing these closing entries, that's the only time income summary account exists. By the time we are done with this four-step process, the income summary account is not going to exist anymore. Okay, so the revenue account is closed against income summary. All of our expenses are also going to be closed against the income summary account. So the normal balance for the expenses is debit. In order for us to close that, we will credit all the expenses and debit automatically goes to income summary account. Once we have closed the revenues as well as the expenses, we will look at the net difference. So with the net difference then, if your revenues are higher, than the expenses, then you're looking at net income. If your expenses were higher, then you're looking at a net loss. So regardless of what the balance in the income summary is, whether that is a debit or a credit, you will bring that income summary account to a zero balance. Okay, so we would adjust the income summary account against the retained earnings account. So if there was income, then you would debit income summary account and credit retained earnings, where retained earnings is going up by the net income. If it was a loss, then you would debit retained earnings account and credit the income summary account. So it depends on how the numbers worked out, whether the company had income or loss. And finally, once we have done step 1, 2, and 3, we would have closed revenues, we would have closed expenses, and we would have wiped out the income summary account. Now, the only thing we need to close out is the dividend accounts. So dividend account has a normal balance of debit. So in order to close that, you will credit the dividend account and debit retained earnings. Now, the normal balance for retained earnings account is a credit. So if you are debiting retained earnings, it means you are reducing the balance in that account because it's paid out in forms of dividend. Once you book this 4-step process, then your closing process is done. This is just a pictorial representation of your closing process. So your assets are accounting equation, which is assets equals liability plus shareholder equity. Shareholder equity is made up of common shares and retained earnings. And under retained earnings, now we are seeing income summary as a temporary account, which will capture the changes between revenue and expenses, and the dividend account that is closed against retained earnings. Once your closing process is completed, then we look at the last post-closing trial balance. So trial balances are prepared multiple times in the accounting cycle. So the post-closing trial balance, again, is just a list of all of your accounts with the ending balances, whether they are debits or credits. The whole idea of a trial balance is to make sure that your total of debit equals total of credit. But if you are looking at post-closing trial balance, then you need to make sure that only permanent accounts are listed at this stage, because all the temporary accounts would have been closed. So we prepared the post-closing trial balance to ensure that we have not missed closing any temporary account. If that's the case, then we would have to come back, close that temporary account, and then follow the process, do the post-closing trial balance again. So total of debit equals total of credit, but also make sure that you're only seeing permanent accounts at this stage, which is all of your balance sheet accounts. This is the example we will do in class and the review of your accounting cycle. So between chapter 3 and chapter 4 basically covers all of your accounting cycle. So in chapter 3, we looked at analyzing our transactions, journalizing those transactions, then posting them to T accounts and preparing a trial balance. So that was the first half of your accounting cycle. The second half of your accounting cycle is to journalize those adjusting entries, then post those adjusting entries on the T accounts. Once we update the ending balance in those T accounts, then we prepare our adjusted trial balance. That adjusted trial balance is then used to prepare financial statements. Once the financial statements are ready, then we prepare our closing entries and finally make our post-closing trial balance as a final check. Once this entire 9-step process is completed, then our accounting cycle is complete, which means next year we can start using our temporary accounts again. They will start from zero. And finally, this is the comparison between IFRS and ASPE. Most of these are with regards to revenue recognition. Okay, so revenue recognition under IFRS is quite intense. We have to follow a 5-step process, but under ASPE, it's a fairly easy process where we look at if the process is substantially complete, can we measure the payment, and is the collectability assured? If all of those three are met, then we go ahead and recognize revenue. That, my friends, is all we have for chapter 4 here.